In this stock analysis, we will take a closer look at Google's mother company, Alphabet. We will analyze this company using 5 different intrinsic valuation models to find the intrinsic value of Google, and by doing so, see if the company is currently trading at a discount. In order for the spreadsheet to load in data from Google, we just need to write the stock ticker into this orange field. As you can see, Google is currently trading at $110.65, and it has a PE value close to 21. If we look at this chart, we can see that Google's stock price has fallen during 2022, and year-to-date performance is currently down with 23%. But if we try to go further back in time, let's say 1500 days, then we'll see that Google's stock price has increased dramatically. And we had the Corona crisis there, but then it's just gone up since then. And first now it has started to reverse and fall a bit. We can here see that the analyst average 12 months target price is $144.96. With the current stock price close to $110, it's now a good time to pick up this company. We will try to analyze that in this video using 5 different intrinsic valuation models. But before we go to the analysis, just a short disclaimer. I'm not a financial advisor, I'm just a random guy on YouTube interested in stock analysis, investments, and creation of analytical tools. The content of this video should therefore not be considered as financial advice. Remember to always do your own stock analysis and due diligence. The first model we will use is Graham's valuation, and the spreadsheet is almost fully automated. All we have to do is to write in the growth rate projection of Google. And I've done some research and found a growth rate projection of 13.5%, which I've added here. And as this is above 5%, we will use Graham's revised valuation, which is less aggressive than his original valuation. By applying this growth rate projection and using the equation above, we get an intrinsic value of $115.60. That is above the current stock price of $110.65, and the difference is only 4%. By applying a margin of safety of 25%, we get an acceptable buy price of $86.7, and therefore we don't get a buy signal using this model. The next model is the multiples valuation model, also called the comparable company analysis. And here we find companies that are similar to Google or operate in the same segments, and then we find the PE values of these companies and find the average PE of these, which is then multiplied by the earnings per share for Google. And when we do this, we get an intrinsic value of $106.84, which is very close to the current stock price. So by applying our margin of safety of 25%, we get an acceptable buy price just above $80. And again, we don't get a buy signal using this model. The next model is Peter Lynch dividend adjusted fair value. However, Google doesn't pay out dividends, so therefore Peter Lynch fair value will just be the earnings growth rate divided by the price to earnings. And again, this spreadsheet is highly automated. The only thing you have to do to find an acceptable buy price is to write in the margin of safety in the end. So by using this equation, we get a Peter Lynch fair value of 0.64. By comparing to the table over here, we see a Peter Lynch fair value under 1 means that the stock is currently overvalued. However, it's possible to rewrite the equation in order for us to find the fair stock price of Google. So when we do that, we get a fair stock price of $71.28. And by applying our margin of safety of 25%, we get an acceptable buy price just over $50, which is almost half of Google's current stock price. And therefore the spreadsheet will not give us a buy signal. Normally our next analysis will be the dividend discount model. However, Google doesn't pay out dividends, so therefore we cannot use this model to find the intrinsic value of Google. So we will skip this and go directly to the next one, which is the discounted cash flow model. And here I've added the free cash flows of Google from 2011 and up to 2021. And during the Corona crisis, Google had some good years, just like many other tech companies, where I can see that the free cash flows increased quite dramatically. And by using these numbers, we find an average growth rate of 22.35%. But I think it's unrealistic to expect that Google can keep growing like that in the next years, and therefore I've added a custom growth rate of 10% for the future free cash flows. I have therefore set this option to custom to tell the spreadsheet to use the custom growth rate. And I've then added our discount rate of 8.5 and a perpetual growth rate of 2%. And down here we have the option to choose how many years into the future we would like to predict the future free cash flows before we add the terminal value. And you can here choose between 5 and 9. And I've chosen 5 to be a bit conservative, taking the current world economic situation into consideration. By using these 5 years, we find this number for the future free cash flows, and then we add the cash and cash equivalent and subtract the debt to find the equity value of Google. And then we just divide it by the shares outstanding to find the discounted cash flow fair price, which is $250. And it should be said that all these numbers I have added are in millions. And as you can see, this fair stock price is more than twice as high as the current stock price for Google. And then by applying our margin of safety of 25%, we get an acceptable buy price of $187.44. As this value is above the current stock price, the spreadsheet will now give us a buy signal. On the final page, we have the summary and watch list, containing the results from our 5 different intrinsic valuation models, and also a watch list with the stocks we have previously analyzed here on this channel. If we look at the intrinsic values from Graham's valuation and the comparable company analysis, we can see they're quite similar. Peter Lynch dividend adjusted fair value is found to be somewhat lower than the other 2 valuations. However, if we compare it to the discounted cash flow model, we can see that all of them are pretty low, or that the discounted cash flow model give a really high intrinsic valuation. In order to see if the results from the discounted cash flow model was way off, I have done some further research using Simple Wall Street. And if we jump to that webpage, we can see that Simple Wall Street finds a fair value of Google of $245.98, which is very close to the value we found. And as you can see up here, they're also using a discounted cash flow model. So I don't think the result we got with our discounted cash flow model is so far off. If we scroll down a bit, we can see that for 2023, they have projected a fair price based on the analyst target estimates of $142.80. This is also pretty close to the average intrinsic value we found of $135.91, which is above the current stock price. And the difference is almost 23%. So if we apply our margin of safety of 25%, we get an acceptable buy price of $101.93. And therefore, based on the average intrinsic value we found using these models and a margin of safety of 25%, we don't yet have a buy signal from Google. But as we have already done for the other stocks we have analyzed, we will add Google to this watch list, so we can easily follow the development of the stock price. And if Google's stock price falls even lower and gets under the acceptable buy price, the spreadsheet will give us a buy signal. So do you think Google is a good stock to pick up now and hold for the long run? Let me know in the comments below. If you like this video, please consider to hit the like and subscribe button in order to get more content like this in the future. And until next time, have a great week.